And some of you have joined with a hard-coded link having Bhavini and my name. So we will post a link on the chat. If you just want to rejoin using that one, that would be great. Okay, great. So we have almost a house full. We are at 63. Um, so let me kick us off. So we are here to discuss about how to save taxes in USA. And for those of you who know Nimit, I guess that getting tax tips from him might not be one of the top topics that you would have imagined him talking about. But such is the versatile personality of Nimit. So for those of you who don't know about Nimit, he's a software engineer, worked with Yahoo for a few years, and then he formed his own company, Full Stack Academy, which he ran for a few years and sold it. And now he's embarking on a new journey, working on tax savings. And unfortunately, we are in the virtual mode. Nimit, I don't know if you're off video, but it seems. Okay, now I can see you.
I'm here.
Okay, great. Yeah, unfortunately, this is a virtual one. If it was in person, I would like to do like a proper Bahuman of Nimit and welcome him with a shawl and mala, etc. But we are in the virtual days. Uh, and just a couple of housekeeping stuff before I pass it over to Nimit. So this Cogen virtual series, we intend to do one session every month. After this, we are planning on AI and LLM learning, as well as real estate investing. And those of you who have not registered for Cogen directory, please register. And if you are interested in volunteering, then please get in touch with me. So with that, let me hand it over to to Nimit to take us ahead.
Okay. Thank you. Thank you, Priyank, for the introduction. Is it just me or is your screen pinned on?
I pinned your screen for now.
Oh,
Should I
really?
remove it?
No, that's fine. It's just for me, somehow your screen is coming up.
It must be you
That's okay.
because I see a gallery.
Okay, that's okay. I'll share
Yeah, and I'll
I'm
also
anyway
start recording.
sharing a screen. So let me just share my screen. Okay. Can everybody see that?
Yep.
Yeah. So as Priyank shared, I'm gonna be speaking about how to save taxes. And since the audience is quite broad, meaning we have people who have all, different backgrounds, I've tried to both touch on like a broader kind of higher level topic of how to save taxes and what are like the core strategies and then move a little, also cover some of the more detailed things. And, based on you, a lot of you sent interesting questions, and so I'll try to cover some of those as well. Um, and then I have a lot of content, but like if we run out of time, then I'll share my contact info at the end. You're always welcome to um, get in touch with me for if you have further questions or if you want to more detail about some of the strategies that I've shared. So okay, so with that, I'll start. So this is kind of what I'm going to talk about. Uh, Broad summary. I'll start with a little about myself. Priyank already introduced me, but I'm I have to say I'm from Gam Bidra. I was born in Mumbai, and we moved to the US when I was about 8 years old. And so I was raised mostly in Connecticut and Kentucky, where I went to high school. And then I went to college at University of Illinois. Later did an MBA at Wharton. And then like the two career things that have been kind of foundational for me in my previous life. One was uh, co-founding Bloomspot and its exit to JP Morgan Chase, and then co-founding Full Stack Academy which was my most recent company, and then selling that too. I'm married to a wonderful wife, and we have a son. And then, where I wanted to add some color as to like, how am I doing this presentation, and where is my interest in taxes and accounting and such. And so after, I think especially after I sold Full Stack, I had a chunk of capital, and I had to do I had to learn what to do about it. If any of you have gone through that, you'll see like your inbox is like gets a fire hose of messages from all various kind of wealth management people, and you're kind of in like this daze. And so I went back to I kind of dusted off my MBA finance and accounting books, and then really spent a long time just like reading and learning. Um, and then in the past 4 years, I've made several investments, a bunch of angel investments, real estate investments, private credit, and then of course have most of my assets still in index funds. And so, this topic is more about asset allocation and investing, and this talk is not really about that, but maybe a future talk to go into that. But that's also a very interesting and deep topic. So most of the tax strategies that I'm going to discuss today, or not most, I would say, some of the tax strategies I've discussed today, I've used myself. Many of them I've seen my colleagues or others use. And then my real like interest in this topic started about a year ago, where I started realizing that even for me, like there was really not a great option for where to get good advice. And and so I decided to start a company in this space. And so this is where I got really deeper into all this stuff. And so, I really, in my previous company, I helped adults find new careers. And here I feel like, finding a way to make your financial life a little stronger is just a great mission for me. And then the new tech we have with AI and AI agents and all the things that are happening there means that I really think that like the very best tax and finance advice that used to be accessible by just a few people who can afford to spend that money should be available to everybody now. And so that's kind of what I'm working on. This presentation is not about that, but that's just a little bit of background about me. So next I want to talk about, yeah, I'm going to dive into kind of the strategies part. And so I think of tax strategies and tax planning in kind of these three buckets. So there's the foundations that really everybody should be doing. And then there's some strategic things that you can do based on what kind of employment you have. And then I think beyond that, you get into like the higher income, higher net worth strategies. And many of these strategies focus on, generational wealth, like passing down wealth in a way that's tax efficient, and how to preserve wealth. There's a really nice book. I forget the exact title, but it's like Only Get Rich Once or something like that. It's like a title like that, where that a lot of that book is about at some stage in your life you're in the wealth growth stage. In some stage you're in the wealth preservation stage, and a lot of the high income, high net worth stuff tends to be in that preservation stage as well. So we'll start at level one, get to two and three, and then there's a bunch of stuff to talk about in each of those. All right, so level one, core strategies for everybody, foundations of management. And actually, I want to just do a really quick check about before I jump into it, like about my sound. Is it coming in pretty well, or is everything okay? It's
Yeah,
good.
it's good to me. Yeah.
Okay. Because I decided to not use my AirPods, because I found that like the Max microphone is better. But okay, so okay, glad to hear. All right, so jumping into the tax basics. I think there's three kind of key things that you should just understand when you think about the basics. Like, the first one that I'll just hit right off the bat is that um, there's two ways to not pay tax, right? Like there's like tax. Well, I guess there's three ways, So the first way is just to not make any money. That's, I think, a really easy way to not pay tax. Um, the second way is to optimize your taxes. And, this is kind of the legal bucket. And this is what this presentation all focuses on. And then there's also a very deep and actually kind of interesting, like third bucket, which is like tax evasion, which is all like kind of the shady legal techniques of how do you save tax. Um, you know, Being like Indians, I think we've seen things in all three of these buckets. And I think we see it happen quite a bit. But I'm going to focus on the middle bucket, the tax optimization, because the tax code is filled with incentives. And really, the way to think about tax optimization is that the government gives you tax breaks for things that it wants you to do. So, for example, you know, there was an electric car credit that the government was giving, like when you buy an electric car, right? The reason they give you that credit is because they want people, or at least whoever came up with that law, is that they wanted more people to buy electric cars. And so the way that the government can incentivize the population to do things is by making those things cheaper. So really by taking advantage of tax credits and tax strategies, in some ways we are doing what the government wants. So I think like this mindset shift is important when you think about this topic, that you're not trying to in a way like you know I think just one kind of funny way to, or one way to think about it is that you're like helping the country, all right, by paying less tax. So maybe you're paying a little less tax, but you're doing the things that the government wants you to do. So I think that's one way to think about optimization. Like, for example, they have, I'm going to talk about this later, but there's a lot of credits that you can get for investing in oil and gas projects. But that's because the government wants, more oil and gas projects to be happening in the US, right? So that's why they create these credits for those types of projects. And so, okay, so I think that's on that topic. There's a few different types of income. I won't go too deep into this. I'm sure most people already know about this. Like the ordinary W-2 income is just what we get. Then self-employment or business income is what you earn, when you're like just like you have a business and you're making money off of that. It's not reported on W-2s. It's often reported in 1099s, or it's not reported at all. You have to proactively report it based on your P&L. And then there's capital gains, which happens when you sell an asset and then you make the difference of what you bought it for. And then there's passive income. So passive income, a lot of people get confused about it. But passive income is when, let's say, you invest in a business, but you're not really doing any work in that business, but the business is giving you some of the profits, is sharing some of the profits with you. And so that's not, it's none of the other three categories, and that's passive income. And so that also has some different tax treatment. So those are some of the things to think about in types of incomes. And then, yeah, and then deduction credits and deferrals. I'm sure this is pretty obvious to most people. So move on from this. So just three common tax myths I want to go over that I think we should get out of the way. One is that W-2 employees can't save taxes. I hear this all the time, but there are a lot of great ways for W-2 employees to, save taxes. Think about how long you spend. Like, if you saw like AT&T charged you $50 extra on your phone bill, I'm sure most of you would spend, 45 minutes on the phone fighting with them to get that credit back, right? But like we often don't spend, that even that amount of time thinking about like implementing tax strategies or thinking about this kind of broader topic of long-term tax planning. And so where, we could potentially save thousands of dollars. So I think W-2 employees can do a lot, but you need to spend time on it. You may need to get some help, and you may need to use your brain and plan a little bit. Like it's not just an automatic thing. I think W-2 employees are also the most susceptible to like being lazy about it, because taxes are kind of being auto deducted out of your paycheck. So you don't even think about it. Like every paycheck, they're just kind of auto deducted. On the other hand, like business owners, they think about taxes all the time because, like if you've ever had to write like a quarterly estimate check for like $200,000 to the government, like you can really feel the pain personally, right? Because it's not like auto deducted a little bit every 2 weeks. And so I think W-2 employees are susceptible um, to those things. Then the like taxes are for tax time, meaning that you should spend the year. You should be planning and working on this all the time, like you do on any other investing or wealth. And that tax strategies obviously are. I mean, there are a lot of tax strategies for high net worth people, but there's also a lot for middle income or upper middle income folks. Okay, so the core tax playbook that I'll discuss here is basically like these four things, and then I'll go through them. I'll go through them reasonably quickly. So first one, I think this one everybody really knows is that you kind of have to maximize your tax advantage accounts. I think the the two things that maybe people are not thinking about all the time are like the backdoor Roth strategies, because a Roth IRA where you kind of put a post-tax money and then you get to take it out also tax-free at the end. It has an income limit, so once you make above a certain amount, you're not allowed to invest. But there are strategies like backdoor Roths and mega backdoor. Like the word backdoor makes it sound shady, but this is a pretty it's a pretty standard and well understood strategy for how you can invest in a Roth even though you have high income. Something to think about is that if you have other traditional IRA or 401k accounts, you have to be very careful doing backdoor Roths. I've seen a lot of people make like this mistake because it changes your basis calculation. And so backdoor Roth is only obvious and easy if you don't have any other existing traditional accounts that are open, traditional IRA 401k open. So think about that. And then the other kind of advanced one to think about is opening up a Roth IRA for your kids. Because your kids can also have a Roth IRA, and they have many years of compounding left compared to us. Like the Roth IRA wasn't even around when I was very young, but like today, if you have a 7-year-old or something, and let's say if you pay them to do some chores around the house or you pay them to help in your business, you can actually invest that money into their Roth IRA. And just the quick calculation here is that if you invested 60,000 between these 10 years of 7 to 17, so only 10K a year, then by the time your kid retires, they'll have about 2.5 million tax-free at retirement. And that's at a pretty like conservative 7-8% growth rate. So for a very small investment, you could leave like a very huge legacy for your kids in the form of a tax-free Roth. And so a lot of people don't think about this at this age. So I
So,
actually worked on a
sorry,
project. Yeah.
can we ask question like, is it even you have to have a business for that, or even a regular, like, salaried people can also pay that amount to their kid?
So anybody can pay that amount to their kid for doing chores around the house. But the key here is that you really have to document this well. You have to pay like reasonable amounts based on what they're doing. And you have to treat them kind of like an employee, because there have been several cases where people who kind of really take advantage of this have gotten in trouble. But I think you don't have to have a business. You can do this just I think if you have a business, it's actually it's a double beneficial strategy, because you save taxes and your kids get the Roth IRA. But even if you don't have a business, you can still take advantage of this by just paying them for doing chores or for helping you, which they're probably already doing, right? So I tell my kid, I'm like, if you just wake up and like just cooperate with me, I'm like, that just solves all my that makes my I feel like I could pay him just to like cooperate. So anyway, I'm not sure if the IRS would agree that as a job, but um, anyway, I'm kidding. I know this is gonna be recorded, and then Sneha's gonna watch this and say, no, our kid is very cooperative and he's great. So all right. So the next thing, I'm not going to spend any time on this because I think most people know about HSAs. HSAs are really great. You should maximize it. It's a health savings account. You can put money in pre-tax and then take it out tax-free. The only one, little slightly interesting technique here is that you don't actually have to pay for your expenses out of your HSA right now. You could actually pay for them with your regular credit card right now, get the credit card points, and then just save the receipts and then let the money grow tax free. And then in 30 years, you can basically take the money out of the HSA at that time. You don't really need to do it like right now. And so the main benefit here is that you can let the money grow tax-free in the HSA, instead of taking it out right now.
And Nimit, what's a good way to save the receipts? Because you're talking about like 30 years.
So I think, this is where it does become a little bit tricky, but the way that this is why I personally don't even do this, because I think there is a good chance that you kind
I'm
of
sorry,
lose
I
the
didn't
receipts.
quite catch. So why do we need to save the receipts?
You have to save the receipts because, when you let's say you have $100,000 of HSA expenses that you've like kind of delayed, then maybe when you're 70, you're gonna like take this money out of your HSA to reimburse yourself. And then at that time, if you don't have receipts, then the IRS can say like, well, prove to me that these were all actual expenses. So the way to get the actual, I mean, I think the only, I think there's just a, you can just create like a Dropbox or Google Drive and just save them all in there. You don't need to save the physical receipts. But if you just create like a consistent way to save them, you can actually make it happen. It's still a little it's definitely still unorganized, and so like I personally don't do this because it's really easy, because also my wife and I both pay for healthcare expenses, and it's like hard to get on the same page about this, and it doesn't end up being like a huge amazing strategy, but it is something nice, so something to think about.
Yeah, but I think you need to save the receipts either way, right? Every time, because you get an HSA withdrawal
Yeah.
form from the HSA provider. And
I'm
if I
slightly
had
losing the point here. When we are putting the money in HSA and we are not spending out of it, then there is no question of receipts, right?
Yeah, if
Well,
you're not
if-
spending, then there's no question. But if
Good,
you're
thank you.
accruing healthcare expenses, then you
Yeah.
have to save those expense receipts.
Thanks.
And so that's what it's about. Yeah.
So for when you withdraw it, you have to prove that you have actually spent that money in the past, and that's what now you are withdrawing that amount.
That's right. Yeah. I think the best, so I mean, this is one of those things that, I'm gonna try, like, I mean, I don't want to really like sell my own startup, but this is one of those things that I'll try automating with AI, that you can like easily, keep track of this over a long period of time. Because I think it's like a nice tax gain, but then it's quite a headache to do it, because I've tried to do it and then I kind of just gave up on it, because like you keep so now I kind of just pay out of the HSA right away, but I think if there was a better system for keeping track of the receipts, and then I could be sure that in like 30 years I'm going to have them, then I think I would maybe use that. But
Yeah, even otherwise, right? See, what I do is I pay off the receipts, using my HSA, but it never utilizes my entire HSA contribution, right? And you
Right.
invest the rest of the money. Me, over the last 8 years, I have earned maybe 2 times or 3 times the money what I actually spent in the HSA by investing that HSA.
Right.
If you don't want the headache, I actually keep all the receipts. I pay through the HSA, but it's like $7,000 if I'm taking an HSA deduction. Maybe $1,500 I'm paying on the HSA bills. Rest of the money goes into investments, and that keeps going.
Right.
Just one more thing, I think gains on HSA is taxable for few of the states. It's not purely
Are you sure?
tax-free. Yeah, according to
Which
me.
state is it taxable? I've never heard of that.
Even I never
California and New
Can you
Jersey
repeat
tax
that
it.
point one more time about taxes?
Yeah, the capital gains that you earn from HSA are taxable in some of the states. I think it's when you withdraw, I think, but
Sell at the point of selling, California taxes, it will generate a 1099 or some kind of form that the gains you have had on HSA account are also taxable in California, at least to my knowledge.
California and New Jersey.
Yeah.
yeah.
Okay.
Also,
So you still get a federal deduction.
Yes, we do. Yeah.
Okay. Yeah. Thanks for letting me know. Okay. So the next thing is around just bunching your itemized deductions. Because our standard deduction has gone up so much in the 2017 Tax Act, you would rather do deductions. You would rather keep taking the standard deduction and then bunch up your deductions. Like, for example, if you're going to make a large donation, you would rather make kind of all your donations at once rather than doing it. So this is just a simple example. I think most people may have already figured this out by now, but this is an important like way to save or to plan.
So you can put it in the donor advised trust, the year, and then.
Let me keep going because I have a lot of stuff that's even more.
Sure. Sorry.
And otherwise we're gonna run out of time on so because these are all just like the basic things that I think most of you, I'm sure you've heard of it. So this one, I'm not sure how many people may have heard of it, but this is the this is kind of the pass-through entity tax credits that the states have. This is like a strategy that many states have come up with to basically get past the SALT deduction limitation. So I'll try to explain this simply, but in the 2017 Tax Act, there was a $10,000 limit put on federal deduction of your state and local tax. So for example, let's say you're making $200,000 a year salary, and your state tax would be $20,000. Before 2017, you could actually deduct this $20,000 from your taxable income when you calculate your federal tax. So your federal tax, it essentially would be $180,000 because you paid this 20K to the state, right? This is assuming just a round figure 10% state tax, right? But then this SALT deduction limitation makes it so that you can only deduct a maximum of 10%, or sorry, $10,000. So you can only deduct $10,000. So then what states did for people who have businesses, and this is, by the way, the what I will talk about later, but the benefits of having a business. So the people who have partnerships, you can actually pay the individual state tax from your business before that income flows to you personally, and then get credit for that on the state tax. And so as a result, you basically bypass this limitation because your taxable income, in your business itself would be reduced. And so then your federal tax would also get reduced accordingly. And so something like 35, 36 states have now passed PTET laws now just to bypass this this kind of I think it was kind of like a targeted limitation for the high tax states, basically mostly like the blue states in a lot of ways. Like it was kind of a tax for those states specifically. But those states have fought back with this. So make sure if you have a partnership that has significant income, like if you're a service provider like a dentist or lawyer or something like that, then make sure that you're taking you're actually electing the PTET deduction before the year ends and then paying it before the year ends. You actually have to pay it before December 31st. You can't wait till like April 15th or something till you do your taxes to get credit for it, because it can actually make a really, really big difference, like especially if you are very high income, which many of you are. So this is a big one, and it's become kind of default because it's just supported across so many states now, and the states have kind of created this just as a way to fight back against the federal government. So this is also a good strategy to think about as kind of like a core strategy. So okay, I'm gonna next talk about kind of the strategies for W-2 earners. I'm sure there's a lot of W-2 earners in the audience, and then just in general. And then, I think for W-2 earners, we've gone through some of them already. I'll talk about a few more of the more advanced ones. There is a overall tax to being a W-2 employee. Like you get some benefits and you get a bunch of things, but then there's kind of like this hidden cost where on the tax side, which many of you have experienced. So you're not really able to deduct many things that a business owner could deduct. Like one example here is that if you're going for a conference, like a W-2 employee will have to, unless you're lucky and your company is paying for it, but if you're just doing it yourself, like a W-2 employee will have to pay for it themselves, whereas a business owner can actually deduct it from their taxable income. And that can save thousands of dollars as these expenses kind of add up. And there's a lot of expenses that you have. Like think about your phone bill, or when you buy a new laptop, or there's so many things that you're already spending money on, which could qualify as business expenses that W-2 earners don't get a chance. So there's already you're kind of one step back already, but there is, it's not like all bad news in a sense. Like there are a bunch of things that you can do, and this is kind of the overall playbook. I'm going to highlight a bunch of these strategies here, and just talk about them as what are the W-2 strategies that, what are some of the more interesting ones that I can think of. So we talked about maxing out, retirement options. We talked about backdoor Roth IRA somewhat. If you invest in real estate, where you invest in, syndicate real estate funds, or you invest in an apartment and then you get some, so that can be a good way to create some non-W-2 income where you can get some like tax benefits. And then obviously you'll also get rental income and appreciation from that. Now, like I said, most of the interesting things in the W-2 tax optimization world, they require some work on your part. And so I think that if you want to, improve your tax situation significantly, you kind of have to do some, you have to do like some work. You have to be willing to do some work that will do that. So I think investing in real estate is one of those. Then muni bonds, I mean, this is like, if you live in certain states that have state-specific muni bonds, most of you probably know about it too, but you can get income exempt, you can get like tax exempt muni bonds for federal and state taxes. They're not, it's not the best strategy, because many times they, unless you're directly buying muni bonds, which many people do, but if you buy muni bond funds, they tend to return kind of like almost equivalently less than the taxable. So sometimes it's beneficial, sometimes it's not. You have to do the math, for yourself. And so then there is, this like you have to strategic loss selling. So if you have losses in things, then you can be smart about taking those losses against ordinary income if possible. You can, even capital, even like passive income losses, you can offset against $3,000 of ordinary income every year. So that's, depending on your tax rate, that's anywhere between $1,000 to $1,500 right there as like a kind of a free tax credit. So so that you can do every year. Like for example, if you lost $10,000 in one of these crypto bankruptcies, you don't have to raise your hand, but I know some of you probably did. But like so then you can slowly every year you can do $3,000. You can take $3,000 of that loss every year against your ordinary income. So something like that can be helpful, and this is something that you should make sure that your accountant is doing for you. And then the other thing is like donor advised funds, which are, or DAFs. So these are actually very powerful as a way to these are very powerful as a way to save taxes. And I'll tell you that it's not just for people who want to make like big donations, because many times there are places where we have to give money anyway, where they may be qualifying as donations. Like some of my friends who send their kids to private schools in New York, like these schools, they kind of require you to make like a $10,000 donation every year, just like as a wink into the school, right? So like every year you have to make that anyway. So then if you do that from a donor advised fund, you can actually save a bunch of tax, because you can take equities that are highly appreciated, donate them to this donor advised fund, get that tax deduction right away, and then use those donations, basically make the donations at whenever you want over your lifetime. And then even while the funds are sitting in the donor advised fund, they're actually growing because you can invest them into equities in the donor advised fund. And so I'm amazed at how, usually how few people even know about donor advised funds. I think it's a very I think a great strategy, or a great tool to use. And most like Fidelity, Schwab, I think even Vanguard, like most of them offer pretty good low cost donor advised funds. There's also a company called Daffy, which if your donor advised fund is going to be pretty large, probably like above 100,000, then they have a fixed cost donor advised fund. So it will it makes a lot of sense. Like some of you may end up having like $1 million donor advised fund, and so there it can make a lot of sense to moving it there so that you're not paying like an AUM based fee on it. every year. So okay, so yeah, so that's on these are kind of like the more like standard W2 optimization strategies. And then these are like slightly more advanced ones. So I briefly mentioned this before, but you can invest in either clean energy projects or oil and gas projects. And these two can be like very powerful to reduce taxes for W2 for W2 earners, because you can have very significant tax credits in the year you invest. You make some extra income, you get a lot of depreciation. The only and major downside, so this is not only, it's a serious downside, is that in order to kind of maximize the credits out of this, you have to materially participate in this investment project, which is like a 500-hour commitment in a sense per year. And so 500 hour per year is like 10 hours a week, but you like the way you count this 500 hours and the way you keep track of it, like let's say if you go to a conference for a week, and you're attending the conference, like that can count for, that can count toward this rule, something like that. So, but it still takes like an actual investment of time. I think you save a lot of money on the other hand, but it's not something you can do just like sitting at home. And that's the same for like oil and gas projects as well. Like you can get a lot of tax advantages through IDCs or other similar things, but they also require material participation. The one which I think is kind of to me is actually like a little known, but like a really great thing to do is using these charitable remainder trusts, or CRUTs or CRATs. So charitable remainder trusts are kind of like an advanced tax planning strategy, but basically you can, let's say, I'll just give you an example to help you see how this could work. Like, let's say you've invested in a real estate property that has doubled in value, let's say, right? Or like, maybe like for a techie audience, like maybe you invested $25,000 in your friend's startup, and now that investment is worth $1 million, let's say, right? So you have like almost $1 million of gain, almost all gain. And if this startup IPOs and now you sell this, you're going to have to pay capital gains tax on that entire $1 million. So that'll be, almost 35%, if not more in California. And so instead, you could contribute your assets to a charitable remainder trust, and I can actually show you I was working on a calculator, but I don't know if I have time to show you right now, but I can send it out to people later. But basically, you contribute to the charitable remainder trust. You can sell it in the trust tax-free. And so let's say now you have a full $1 million in that trust, and then you can invest it. And then from that trust, you can get a annuity payment for the rest of your life. So you can get, let's say, 5% of that trust like every year for the rest of your life. And like basically, and then whatever remains when you pass away will be given to the charity that you choose, which can also be your donor advised fund, if you want. And so yeah, I'm in a presentation right now, but whoever the room with the bar whenever okay. Okay, sorry. So this is a strategy that I think not a lot of like people think about when it comes time to sell these highly appreciated assets, but it can be very powerful. Even if you have company stock that let's say you're like an NVIDIA employee, and now suddenly you're like a deca millionaire, and now you don't know what to do with all this like taxable gain that you have, and so contributing it to a CRUT can be a really good strategy. And so I've looked at these a lot. Like, and this is one of those things where, probably impacts the, high net worth people a little bit more. But I know there's a bunch of those here too, so I'm sure that that's something worth looking into. Okay, so next I'm gonna talk about the strategies for business owners, and then as you guys know, like business owners have a lot of options. Like business owners are the kings of tax strategy in a sense. Like there's so many things that they can do. But here are some of the interesting ones. Like you have more options for where you can contribute in your retirement. You can control your expenses. And so that can actually, help you quite a bit in your day-to-day life. You can employ your family members, which can help them in, n number of ways. Like, you can shift income to lower brackets if you're employing, like, let's say your kids, or if you are employing a spouse, then you can make sure that they get Social Security benefits and such that way. There's also something called Augusta rule, where you can rent your home to your business for 14 days and then take income from that tax-free out of your business. And so that lowers your taxable income in your business, but you would kind of take that and you don't have to pay any income tax on it yourself. And so, for example, let's say you hold like a board meeting at your home once a month. Then you can actually charge your business, let's say $500 for renting your meeting room or something. It like the amount you charge has to be, very realistic and something that you actually can get at like a hotel nearby or something. And then you take good notes about doing that meeting and actually, sending meeting invites and all that stuff. Then you can take like that $6,000 tax-free out of your business. So that's another, that's right there, depending on your tax rate, that's like a $2,000 to $3,000 every year that you can take savings of taxes. Then with real estate, I talked about this a little before, but you can do a bunch of stuff in real estate. I mean, real estate tax savings is like a whole presentation on its own, but you can do a lot of stuff. Like you can do cost segregation studies, like depreciation helps you delay taxes. And some people keep depreciating. If you're like investing, if you're doing these 1031 exchanges, one property into the other, like a lot of real estate investors like never pay taxes because they're constantly depreciating properties. And then they die at some point, and then like that's it. Like you don't have to pay any taxes. That's the great way to get out of taxes too, by the way. But that's not a strategy I recommend. So, and then there's the home office deduction also that you don't get if you are a W-2 employee. So, like for example, even if you're work from home, like or you're like a remote employee, you can't take your home office as a deduction of your W-2 income, which is kind of silly, right? But if you're a business owner, you can. So things are not fair in that way, but business owners have a lot of options. And so really like the number one suggestion actually for people who are W-2 employees is to start a side business. Because I think you can have your cake and eat it too if you go ahead and just start like a side business, or your spouse starts a side business, or you have some way where you start making some meaningful revenue or meaningful income outside of your regular your kind of regular income. And so there's a bunch of other stuff in the business tax playbook. I'll go through some of the more interesting strategies quickly here. So if you are a partnership, you can actually declare, depending on your income, if you declare yourself as an S Corp, then you can decide to, so S Corp distributions don't have to pay any employment taxes. So, let's say like the example is the easiest to look at. So let's say there's a, Dr. Maru's medical office. Let's say they're making 300K income regularly. And then so that means they're paying probably $45,000 in self-employment tax. Well, after they change to an S Corp, they can change their salary because it's their own S Corp. They change their salary to 150K. So they pay the self-employment they pay self-employment taxes on the 150K, and then they take the rest of it as a distribution. And so then they only pay 22,000 of self-employment tax instead of 45,000. So right there, you get a $22,000 annual tax saving, right? And this is annual. So just think about like if you invested this $22,000 every single year, like by the time you retire, it'll be like several millions of dollars of total savings, right? And so just something as simple as this strategy alone can, double your net worth by the time you retire. Then, we've talked about like a retirement plan maxing a bunch of times, but there's like, I'm going to go through quickly because we're running out of time, but you can there's things like cash balances plans where you can contribute like a lot. You have to set it up at your entity level, at your partnership level, but you can contribute much more than like a regular 401k. Then there's also like a defined benefit plan. These are more like, in the old days, there were kind of pensions. So these are more like you could create a pension for yourself. These can also be beneficial, but they're more useful for when you're I think they're more useful when you're a little older. And both of these are useful when you have like a consistent income. So it's not good, but for like if you're going to sell your company or something and then 1 year just make a lot of money. So if you're like a physician, let's say you're making 500K every year, then doing something like this could be very beneficial. Next thing, I've talked about this before also, but hiring your family. So this is a really powerful strategy. Like, you can hire your kids after they turn 7 and just hire them for a few hours per week. You have to make sure you do a good job documenting everything, and then you're actually paying them in the right way. But basically, just as a calculation, like if you pay them 7,000 a year, and then they work, then you're saving like a bunch of taxes every year. Or I guess, sorry, this calculation is wrong. It should be probably more like 2,800 per year. But like at an 8% growth rate, you could have your kid could have millions of dollars at the end. And I think we don't think about it because usually people don't open up Roths till their mid-20s usually. And if you say that you're going to work from, let's say you're going to work till 70 and you're opening up a Roth in mid-20s, when you're 25, let's say, that's 45 years to compound it. But if you open up the Roth when you're 7 instead of 25, then you add another 18 years of compounding to your Roth IRA. Like that last basically 15 or 18 years of compounding is insanely powerful to grow the value of, what they have at the end. And so, I think this is one of the best strategies for like, if you like your kids, this is a really good strategy. And you want to invest in their futures. So, okay, so these are a few strategies that are a little bit more advanced and like higher net worth, higher income. And so I'll go through these quickly. I spoke about these a little earlier, but a lot of these are around like saving taxes and wealth across generations. And how the other topic that a lot of times people who think about this, they don't talk about is like how do you maintain and this is probably a topic for another presentation, by the way. Priyank, I hope you're keeping track of all these presentations that we have to do. But
You're
is that
giving me
like how
more
do you
tasks right now.
is that how do we pass on like our values across generations? Because we like there's a lot of strategies to like pass on money, but I don't think that people really learn how do you pass on values other than just like just kind of we just kind of be ourselves every day and we hope for the best. But as the amount of money that you're passing on grows, then you have even more responsibility and then you end up having a little more stress about how, what's going to happen to the next generation, the generation after that, and what do you want to happen? And so it's not for the scope of this conversation, but anyway, okay, so the advanced playbook, one important one is like a self-directed IRA. So if you have like a Roth IRA, you can use there's actually a bunch of companies that help you with this, but one of them is like Alto IRA that I use. But you can take your money that's in the Roth IRA and then invest it in alternate assets. And I like to invest them in high risk assets, such as like startups, for example. Like I do a decent amount of angel investing through my Roth IRA, and I think it's a good idea because startups can be they can either go to zero or they can have like a really great outcome many times. So I mean there are obviously kind of middling outcomes as well, but they have a chance to have a really large outcome. And then in the Roth, like if you have a really large outcome, you can have a pretty amazing tax savings basically. And so if you're investing in things like crypto, or you're investing in startups or any other high risk things, then it's a great idea to do it through the self-directed IRA. And like some examples I've listed here of these are people that have these like hundreds of millions of dollars in their IRAs by doing exactly this, like taking money in their IRA and then using it to invest in different assets. In the past, like many years ago, when some of these people probably did it, it was quite complicated to invest in like self-directed IRA and then invest in assets yourself. So most people didn't do it, but now there's a lot of companies that help you with that. And so the one I use, Alto IRA, also has a really good integration with AngelList. And if you've invested in startups, a lot of companies use AngelList to raise money, and so it also makes the investing process really, really easy for the founder as well. So I think this is a good and then the other one is like trusts. So I talked about CRUTs and CRATs before. Oh yeah, so I have the link to the calculator here, but there's another one called GRATs. There's actually like tons of different types of trusts. Like you can if you go into this world, if you plan on having wealth that's like higher than the lifetime gift limit, which right now I think is like 25 million or something in that range, then this world is extremely deep and there's tons of stuff. Like so a GRAT is another good interesting one to know about, because you can actually contribute assets that are going to appreciate. So for example, if you know that you're going to sell your company in a year, and that right now on 409A valuation it's worth, let's say, $1 million, but next year you're going to sell it for $10 million approximately, you can contribute some of your shares to a GRAT, and so it lets you receive basically the gain for you can basically receive the gain tax-free, I think, like something like that. Or no, sorry, you get the basis back, but your gain stays out of your estate in the GRAT tax-free. So let's say like in this 1 million going to 10 million example, if you invest, if you put like 1 million of shares into the GRAT, and then next year they become 10 million, you can take that 1 million back out essentially for free, just as payments to yourself. But then that 9 million gain sits in the GRAT tax-free, basically outside, and it's also outside of your estate, right? So that let's say if you're gonna be worth $50 million one day, then you want to move money out of your estate as much as possible, because like the death taxes or estate taxes, which we haven't even talked about here, they're extremely high. Like in New York, where I am right now, like if you die, like anything above this like lifetime gift exemption, it's like more than 50-60% taxed, something like that. So like if you die with an estate of like $200 million, you get 25 or whatever million passed on for free, but like 175 million of that is taxed at like 50-60% rates. And so it's extremely high. So people spend a lot of time thinking about how to reduce that and manage that. And that's also why a lot of these, like people also start giving their money away a lot when they're wealthier, partially because otherwise they're just gonna have to give it to the government. And so they might as well give it where they want to give it when they're alive. And then, so the other interesting one is life insurance. So usually, I wouldn't suggest like buying whole life. So okay, so there's kind of a purpose in estate planning for both term and whole. So sometimes if you want to, so in your estate plan, if you want to give some assets to somebody who isn't in your regular kind of distribution funnel, you can use term life insurance to do that. Like, for example, like if you want to say, okay, like, I have this friend who I am like supporting right now with some money, and if I were to pass away, like they're going to really be in trouble, then you can take out a term policy on yourself so that they get some money. And so that they don't have to wait for your probate and estate process to finish to get some money out of you. More commonly, this is done with like parents, let's say, like let's say if a lot of your estate is going to pass on to your kids, but you're still supporting your parents, you can take a term policy on yourself that it benefits your parents so that they get something in case of your death if you die early, and they don't have to, potentially they don't have to get in any battles with your spouse or their family, or basically they may also be at an age where they don't want to deal with all that. They just want a good chunk of money that just will help them survive. And so term insurance can be used for things like that. Whole life insurance is used for wealth transfer mostly. I think, like, I don't know of any other good use case of whole life insurance other than just like wealth transfer when you're going to be above the 25 million net worth limit. And so if you are going to be above 25 million net worth limit, whole life insurance can be pretty good way to pass on, move money out of your estate and pass on money to your heirs. You can create this like ILIT trust that kind of holds the policy, and then you can pay for the policy's payments with gifts to that trust. And you're allowed to make gifts of up to, I think, 30K every year. So you can make gifts to that trust tax-free, basically, and pay for that policy. So anyway, so we'll leave this at that. And then next one is around like Section 1202 QSBS. So if you're doing angel investments or you have your own, I don't know how many people here are founders or have their own companies, but if there are people who have their own companies, you want to make sure that I think a lot of people, when I started Fullstack in 2012, like nobody was really talking about QSBS or Section 1202, and I was pretty excited and amazed that we actually qualified for QSBS. And so this is definitely something you should look into and make sure that you don't violate any of the rules that allow you to get this benefit, because you can take basically, if your company qualifies for QSBS, you can take the first $10 million of gain when you sell the company completely tax-free. And at least in New York, it's completely tax-free. I think in California, the state tax you still have to pay, but federal tax is free. And so this is a really awesome strategy. And then there's a few other ones that are related to kind of stock options for people who are startup employees or big tech employees. If you haven't heard of exchange funds, they can be pretty good to look at. Like if you have stocks that are appreciated, such as, let's say you have a lot of stocks in Google or Nvidia or something that have appreciated a lot, you can actually, now you may be scared. Like, let's say you have $5 million of just Nvidia stock, right? You're like, well, if that one company drops, like how Tesla dropped in half over the last like 3 months, right? Like you never know what can happen. So you want to diversify your assets. So then you can actually give those shares to an exchange fund, and then they will in return give you that same amount of shares in their own fund, and they're getting these shares from employees from all these different tech companies. And so they create kind of like an index fund of all these private shares. And then they give you a slice of everybody's share. So you get a lot more risk protection by doing that. And so a good company that has been doing this recently is called Cache. If you have to CACHE, if you want to look into it. And then you have to manage your AMT exposure. I know I'm like out of time, so maybe I'll just stop here because I think I'm already kind of done. But yeah, you guys can see the other two. You have to plan your AMT exposure, and then there's something interesting called the NUA election when you sell company stock, but it's a little specific to people who have company stock. So I'll leave it at that. But yeah, so that's it. Would love to take any questions, or if people want me to go back to any slides, then let me know.
is there any difference between LLC and S Corp if you can pay? Because I thought that LLC you don't have to pay any corporate like tax annually, but S Corp you have to. Or any such differences you can think of?
So an LLC.
Sorry, Nimit, to interrupt. Before Nimit answers any question, I have one request. If everyone can take 5 seconds to come off video, I need to take one group photo before people start dropping off.
Okay.
And Nimit, if I can request you to stop sharing.
Yeah.
Amazing. And let me remove the pin. Okay, great. Dimple or Bhavini, are you able to take the screenshot? All right. So in 5 seconds, if everyone is ready now, I can see only limited screens, but I see a lot of people. Oh, Shailesh Bhai and Varsha Ben are driving. Okay. Hello. All right. 3, 2, 1. Say cheese. Okay. I hope we got them. All right, Nimit, please go ahead.
Okay. Okay, cool. So the question was about like LLCs and S corps. So an S corp is essentially a partnership that like elects to be taxed like a S corp, like it's a partnership that elects to be taxed that way. There's not like so I think there's a benefit in terms of that you can choose to like not pay so you don't have to pay employment taxes on the distribution. But otherwise, if you're making income in either entity, there's not like there's not any other base like tax reduction that I know of from having an LLC versus an S corp. Like the main strategy is that you can reduce your income, and so you pay less employment tax compared to.
I believe even if you have LLC, you can elect to make it taxed as a S corp.
Yeah.
So
Yeah. That's what I'm saying. Like they're both partnerships. You can just have it taxed. And I believe that even like creating a S corp is essentially like creating a partnership that's taxed like a S corp. But anyway, yeah, I think there were some questions in the there were some questions in the
Chat
form, like the registration form about like can making an LLC give you some tax benefits? There's not really any benefit to making an LLC unless you want to create an entity that can capture some liability for you. So if you're like a single person, let's say you're like a single consultant, right? And you're doing like a tech consulting, then you can do it as a you can do it yourself as like a solopreneur basically, without doing an LLC in the same way. Like having an LLC doesn't give you any benefit per se. You can also take expenses against your income in the same way. Having an LLC, if anything, gives you more headaches because you have to now file another tax return. You have to pay taxes to the state for having the LLC. And so there's not, and like the main benefit, especially if you have a multi-member LLC and you're keeping all the expenses and revenues in that LLC, the main benefit is you can try to capture some of the liability in there. So if in your business, you do something and you get sued, you can potentially not get personally sued, and you just keep that liability in the business. So that's one of the main benefits. Obviously, when you're bigger, it's easier. I mean, you need to have a business separate. Sure. But
amazing.
okay, guys. So yeah, feel free to I can just put up my like contact info again, but yeah, feel free to get in touch with me if you have any further questions or any improvements or something like that about anything that I talked about.
Are you going to talk a little bit about your the company and then how much do you charge on one? I went there and it said to get onto the wait list, put your name.
So yeah, if you're interested in so essentially Waterfall is like a tax firm that files your taxes, but then uses software and AI to help you implement all these tax strategies that a lot of them that we were talking about. So you have like a team of people that and software that's like helping you implement these strategies. If you put yourself on the wait list, then I will reach out about more information. Like I'm still figuring out the pricing. We're in the process of like fundraising and then building software, and there's still a process happening. But put yourself in the wait list. I think it's a pretty exciting space. Like I'm personally like kind of obsessed with it at the moment, and so like I just see that there's a lot of things that people don't do just because it's kind of a headache to implement them and to do them. And so I think that in this kind of new world, you can build software to do a lot of that with you. And so that's what I'm trying to do.
Do you think having maybe equal 50-50 of Roth IRA versus the traditional IRA when you roll over, when you contribute or anything like that? Do you have any major, what would be the good strategy in general?
I think if it were me, I would max out the Roth IRA first, and then do more in the traditional IRA or 401k that you can. Just because the Roth IRA is very flexible. Like one thing I didn't talk about is that Roth IRA doesn't have required minimum distributions when you are about to retire. On the other hand, like a traditional IRA or a 401k, when you turn 70,
I think 73 now.
73 now. So when you turn 73, the government will force you to take money out of that 401k, even if you don't need it, even if you have other sources of income, and then force you to pay taxes on that. And so ideally Roth IRA is much more flexible. You can also, it's much easier to invest in like startups or, other things in the Roth IRA world. And so, yeah, I would do Roth IRA first and then put it in the other things.
So if you want,
sorry, go ahead.
Yeah. So if you want to invest, say, your Roth IRA into what is startups or something like that, and then do you have to convert it into, you can directly invest, or what are the steps needed to do that step?
So you would have to make an account at something like a Alto IRA. I'm not selling their service at all. I just use them myself. There are a few other ones that are also good, but I've been using them for a while, and so that's the one I know. But basically, you make here. I'll show you my So you basically make an account there, and then you have to fund the account by transferring your existing Roth IRA, which is probably sitting in like Vanguard or wherever it is. Here, can you see that? So like I haven't even looked at this site in a while, but basically you create an account here, and then you can fund it from your existing Roth IRA, and then you'll have a bunch of money sitting here. And then you can either invest it in specific startups, or they also offer now, like they have a huge like marketplace, it seems like, for a bunch of deals that you can do yourself. So it just allows you to diversify your investments from like the usual index funds that you may have most of your investments in right now. And especially if there are investments that you're making that are high risk, like early stage startup investing. And I think this is a good place to do it because you can just like shelter a lot of those gains.
The other thing, question about the Roth IRA, right? If you are contributing to your regular at 401k and then you can't contribute there, the other way to do it is you contribute to your IRA and then convert that, withdraw it and put it into Roth. Is that the strategy, backdoor strategy that you were talking about? Or